Tellurian has a dream. It wants to produce natural gas in the Haynesville, send it down to the U.S. Gulf Coast, liquefy, and export it. It's going to cost as much as $24 billion. Most companies find long-term buyers of LNG to raise money for CapEx, but Tellurian is testing out a new business model. It created Driftwood Holdings, a company made up of its production, pipeline, and export terminal assets. You can buy in for $1.5 billion and get 1 million tons of LNG each year at $3 MMBTU. Now, Tellurian already has big partners with big money, but others are skeptical. The company has lost half of its market cap since its IPO. Well, Charif Souki, the co-founder and chairman of Tellurian, joins me now. Charif, always great to catch up with you.
Thank you, Alix. Congratulations on your new show.
Thank you. The last chart that we showed in that piece showed Tellurian's market cap since the reverse merger when you IPO'd and how it lost about half of its market cap. Why do you feel like investors, is it a hard sell right now for investors?
No. It really doesn't matter much. We've lost a lot of market cap in the first part of the year, but we gained it all back in the last couple of weeks. So we're back to right around $2 billion.
But do you feel, when you're going out to try and sell your new business model, is there skepticism? Because there's investor interest, but there's so many different ways to play it. Is it hard to get investors on your side?
It depends if you mean investors at the Tellurian level or investors at our project. So for the Tellurian level, we don't really pay too much attention to it because we don't really need any capital. And a lot of management and Total own a very large portion of the company, so it doesn't really matter. To bring investors with us into the project, that is really the crux of the matter. If we're successful with this, we're successful with everything else. The rest will follow.
And I spoke to Robert Santangelo. He heads ECM over at Credit Suisse, and he said investors are very interested in the right way to invest in LNG. Here's what he had to say earlier on the show.
I think investors see the U.S. as a significant exporter of LNG, and I think the level of interest that we've seen from investors in LNG has grown significantly in the last 6 months. I think that there have been a limited number of investment vehicles that provide direct access to that, and I think people are in fact looking for that.
Do you feel like you guys filled that void?
I think so, yes. I think, as you know, we've launched our marketing effort for the partners about 8 weeks ago now, and the initial response is extremely good. We now have active negotiations with 25 different parties. The crux of the matter is to be the low-cost provider. And low cost means 4 things. The first one is access to cheap gas. The United States has cheap gas, especially now with what's happening in the Permian Basin with associated gas. Infrastructure that takes it to the market, and the infrastructure, the pipelines mostly, we're not geared to bring it down to the coastline so that we can export it, so we have to focus on that and do it right. Cheap liquefaction, that is our management team's expertise because we've done it 7 times. We've done it always on time and on budget, so this is where we're very good. And then finally, cheap capital, because if you have to finance everything during a 4 or 5 year periods, and you have to accumulate interest and cost of capital during that time, it becomes very expensive. So you solve those 4 riddles and you have the cheapest gas in the world.
So let's focus in on gas prices, because the key to that is going to be keeping them low, and you are expanding in the Haynesville in order to do that. What happens if your production costs rise?
Okay, so first, the Haynesville is just one option, and at the moment it is not the most attractive option. What is happening in the Permian Basin with associated gas is a lot more significant. So you now have very significant companies with very significant growth in oil production that have to find an outlet for the gas. So the amount of available gas that is going to be produced as an associated product in the Permian Basin that has to find an outlet is staggering. And this is why you're seeing the Waha hub starting to trade at a very significant discount. So today it's very attractive on a long-term basis to own some production cheaply, but it's even more attractive to be able to source gas at the Permian Basin. You can probably save between 75 cents and $1 in MMBTU by sourcing it there today.
So your expansion plans for the Haynesville, is that on ice right now, and you're looking to just have an offtake of associated gas in the Permian?
We're always looking. The Haynesville is attractive. I think we're talking to a lot of people, and we have prices in mind at which level we would pull the trigger. But this is not the first focus today. The first focus today is our Permian Basin pipeline proposal that is in open season now. And we're looking at the Waha hub. It's trading at probably 90 cents to $1 behind Henry Hub today. If you look at the indications for 2019, it's trading at $1.25. If we could source gas in the Permian Basin at Waha at $1.25 and move it down to the facility, it is by far the cheapest gas that we would find in the United States today.
Do you see Waha going to zero or negative? Some say that could happen.
Why not?
So it could happen.
Well, I mean, just put the numbers together. We are moving 7 or 8 BCF a day, and if you listen to the oil producers, the associated gas that comes with it is going to take that number to 20 BCF a day. What are you going to do with it? There's a point where it's no longer an asset, it becomes a liability. And the question is, will you develop two things? The pipelines to move it to market, and the market. Because a pipeline that goes to nowhere is not very useful.
So if you're going to sell LNG to fixed costs of $3 MMBTU, but then you wind up really sourcing from Waha and the Permian, how much can you make off of that?
No, Alex, we are not selling LNG.
Well, when you sell your equity stake for Driftwood Holdings, if I come in and buy, I'm at a fixed price.
So my partner is looking at the same economics as I'm looking at, because I'm going to keep a small piece of the facility as my fee for having done all the work and the 3 years that we spent and the $500 million we spent so far to develop this project. And by the end of the year, it'll be ready to start construction. So my partner is looking at the same economics. If I can drill in the Haynesville or source in the Permian Basin, it's the same optionality. We need to be able to do both because it's a 20-year project.